Up to this point, we've established two foundational truths. First, price only moves when liquidity is consumed or removed. Second, market orders and limit orders play fundamentally different roles in this auction. So in this lesson, we're going to take those mechanics one step further by reframing liquidity itself, not as a line or a level, but a finite resource. And this distinction is critical if you want to understand why markets behave the way they do, because liquidity is not infinite. At any given price, there's only a limited amount of resting liquidity available to transact at that price. So liquidity exists because passive participants are willing to do business there for a reason. And that's because large participants cannot simply enter or exit positions whenever they want. They would have to take on enormous fees, deal with slippage, and potentially not getting their positions fully filled at all. So big participants require this liquidity to enter in efficiently. And that requirement is what shapes market behavior, because this is why liquidity sweeps become one of the most important functions in the market. Stop losses or liquidity pools are not random. And we know this, they're very predictable. We know that stops tend to accumulate around prior highs and lows or obvious structure points and areas where traders expect invalidation. From the market's perspective, these stop clusters represent available liquidity. They're known pockets of orders that can be consumed by them. It's not done with malicious intent, it is a structural necessity because large participants need this liquidity, and stops are one of the most reliable sources of it. So, this is also why swing failure patterns exist so much in the market, and why later on in this course it will be one of the most important catalysts that we can take advantage of. So, when price pushes through a prior high or low, what's happening mechanically is not traders getting tricked. Liquidity is being accessed for a reason. Resting orders are being triggered and stops are being converted into aggressive market orders, and that activity provides fuel. Now, whether price continues or fails after that is a separate question. But the key point here is this: liquidity is targeted because it is required. This reframing matters because it changes how you interpret price behavior. So when you see price move quickly into a higher low, the question is not, is this a breakout or is this a fake out or some type of manipulation? The correct question is, what liquidity was accessed here and what happened to it after it was consumed? Aggressive participants provide pressure and passive participants provide the inventory. Neither side controls outcome by themselves. Outcome is determined by how much liquidity exists, where it exists, and whether it remains available when pressure arrives. When liquidity is plentiful, price struggles to move past that wall. When liquidity is scarce, price moves very easily. So that relationship governs everything. So at this point, you should understand why markets are drawn towards obvious areas, why stops are repeatedly targeted, and why liquidity is real constraint on execution. So in the next lesson, we're going to examine what happens when aggressive effort meets this finite liquidity, and why large effort does not always produce movement.